Are you new to the stock market? Stepping into the world of investing can feel overwhelming, especially with all the information and opinions swirling around. Let's save your portfolio from disaster. We want to help you navigate the complexities and avoid potential pitfalls that can derail your financial journey. By avoiding the 5 most common mistakes, these are the errors that can significantly impact your returns and set you back. Beginners make. Recognizing these mistakes is the first step towards building a solid and successful investment strategy. The stock market isn't a casino. It's not about luck or chance. It's about smart, long-term decisions, grounded in research and understanding, not chasing overnight riches. Forget the hype and focus on sustainable growth. I've made these mistakes myself, and believe me, they can be costly. So learn from my experience and the experiences of countless others who have walked this path before you, and protect your money. Your hard-earned savings deserve to be treated with care and respect. Grab a notepad because we're about to get into the specifics. And let's dive into the first mistake, the one that often leads to the most significant losses. That trips up almost every new investor. Understanding this mistake can save you a lot of heartache and financial setbacks. Mistake number 1, and it's a big one. Investing without research. Blindly following the crowd, hoping for the best, without understanding what you're actually investing in. Jumping into a stock because of hype or FOMO, fear of missing out, is a recipe for disaster. It's gambling, not investing. Investing requires knowledge, understanding, and a well-thought-out strategy. If you wouldn't buy a house without an inspection, carefully checking every nook and cranny, don't buy a stock without understanding the company. Dive deep into their financials. Understand their business model. Know what the business does, its financial health, and its competition. Understand the landscape it operates in. If you can't explain why you own a stock in simple terms, you shouldn't own it. Do your homework. Real wealth is built on knowledge, not rumors. Don't let speculation drive your investment decisions. Mistake 2, trying to time the market. No one can consistently predict the perfect time to buy or sell. Most people who try end up missing the market's best days, hurting their returns. The smarter move, invest regularly and stay invested for the long haul. Timing the market beats timing the market every time. Mistake 3, putting all your eggs in one basket. Even great companies can stumble, and betting everything on one stock is risky. Diversify across different companies, industries, and asset types. Index funds or ETFs are a simple way to spread your risk. If one company falters, others can help balance things out. Diversification is your best defense against the unexpected. Mistake 4, letting fear and greed control your decisions. Buying high out of excitement and selling low out of panic destroys wealth. The market rewards patience, not emotional reactions. Automate your investments with regular contributions to remove emotion from the process. Stick to your plan no matter what the headlines say. Consistency beats emotional decision-making every time. Mistake number 5. A very common pitfall that many investors stumble into. It's something that can easily be avoided with a little forethought. Investing without a plan. It's like setting sail without a map or compass, hoping to reach a destination you haven't even defined. Without clear goals and rules, you're essentially gambling with your future. You're likely to fall for hype, succumbing to the fear of missing out on the next big thing. This can lead you to make emotional choices, buying high and selling low, the exact opposite of what successful investing entails. So how do you avoid this? Write down your goals. Carefully consider your risk tolerance and develop a well-defined strategy. For example, I'll invest $500 a month in an S&P 500 index fund. A simple yet effective approach. And only review my plan once a year, avoiding the temptation to constantly tinker with your investments. A written plan keeps you disciplined, preventing you from straying from your long-term objectives. And it keeps you focused on the long term, reminding you that investing is a marathon, not a sprint. When in doubt, when the market throws you curveballs, return to your plan. It's your anchor in rough markets, providing stability and direction when you need it most. There you have it, the 5 mistakes that can wreck your portfolio. Avoiding them is about discipline, patience, and sticking to a proven strategy. Building wealth takes time, but you're in control of your success. Like, subscribe, and share which mistake surprised you most in the comments. Thanks for watching. See you in the next video.